Hey there, fellow dividend investors. We've all seen how the Straits Times Index or STI has been breaking records this year, climbing to levels we haven't seen in a long time. No one calls it the super terrible index anymore. Alongside the STI, many of Singapore's blue-chip dividend shares also surged to their own record highs. But here's the twist. While investors were basking in joy, a few of these key stocks have suddenly declined substantially from their highs. Share prices that looked unstoppable just months ago are now struggling, leaving anxious investors wondering, was that the peak, or are these just catching their breath before the next leg up? In this video, I'll walk through 3 familiar Singapore blue chips that have each declined meaningfully after strong rallies. We'll look at what drove their share prices up, why they've fallen back, and the lessons dividend investors can take away. And at the end, I'll share my personal view on what I might do in such tough situations. Singapore Airlines, strong core, messy associates. Singapore Airlines is our flag carrier, flying passengers to and from 129 destinations worldwide. It's also one of Singapore's most recognizable blue chips, and in recent years it has rewarded investors with healthy dividends and a strong post-pandemic recovery. Earlier this year, the stock climbed to $7.60, and on a 5-year basis SIA has surged over 80%. It was boosted by robust passenger volumes, full flights, and cheaper fuel. Scoot was operating at nearly 92% load factors, and the core airline delivered operating profit up 42% quarter-on-quarter. Even the cargo arm benefited temporarily from front-loading ahead of U.S. tariffs. A weaker U.S. dollar helped too, cutting costs since 2/3 of expenses are U.S. dollar denominated. But the SIA Group results told a different story. Net profit plunged nearly 60% year-on-year to $186 million, not because of its Singapore operations, but because of Air India. Following the merger of Vistara, SIA now has to consolidate Air India's results. And Air India had a tough quarter. Compensation provisions after a 787 crash, a temporary 15% cut to wide-body flights, and weaker yields. Some analysts now project SIA's 2Q FY 2026 net profit could fall nearly 50% year-on-year to just $150 million, once Air India and lower interest income are accounted for. On top of that, passenger yields slipped nearly 3% as more capacity came into the market, while interest income fell by $61 million as cash balances shrank and rates declined. Valuation added to the pain. At $7.60, SIA was trading at around 1.45 times book value, close to 3 standard deviations above its historical mean since 2011.